Welcome to Shadowline News. I'm bringing you a comprehensive look at one of the most remarkable transformations in modern financial history. Today, we're exploring how cryptocurrency evolved from a fringe digital experiment to a mainstream corporate asset class that's reshaping the global economy. When Satoshi Nakamoto introduced Bitcoin in 2009, the financial world responded with profound skepticism. Traditional institutions and regulatory bodies dismissed this digital currency as nothing more than a curiosity. The cryptocurrency's first real-world transaction perfectly captured this sentiment. In 2010, programmer Laszlo Hanyecz paid 10,000 Bitcoin for 2 pizzas, highlighting how little practical value people saw in this new technology. The mainstream financial world simply couldn't wrap its head around a decentralized digital currency operating without central authority. This concept seemed radical, even dangerous to traditional banking systems. Early adopters faced significant challenges as cryptocurrencies were associated with technical complexity and viewed as purely experimental. The early cryptocurrency ecosystem faced substantial regulatory headwinds, and for good reason. Bitcoin's anonymous nature made it attractive for illegal transactions. The infamous Silk Road marketplace operated from 2011 to 2013, as an online bazaar for illegal goods and services, creating a lasting association between cryptocurrency and criminal activity. This connection significantly damaged crypto's reputation among regulators and mainstream institutions. Then came the Mt. Gox disaster. In 2014, approximately 850,000 bitcoins were stolen from this major exchange, highlighting serious vulnerabilities within the system. This hack reinforced perceptions that cryptocurrencies were unsafe and completely unsuitable for serious financial applications. Financial regulators worldwide took an extremely cautious approach. The Central Bank of Kenya issued warnings against virtual currencies in 2015, citing concerns over illegal activities, lack of consumer protection, and absence of regulatory frameworks. Similar sentiments echoed globally, with regulatory bodies raising concerns that cryptocurrency accounts couldn't be frozen, seized, or examined by law enforcement. The Federal Reserve later implemented restrictions on cryptocurrency banking activities, with the board presumptively prohibiting member banks from holding most crypto assets due to security concerns. But change was coming. Around 2018 to 2020, the cryptocurrency ecosystem began maturing despite these early setbacks. Traditional financial institutions started recognizing the potential of blockchain technology, even while remaining cautious about direct cryptocurrency exposure. This period saw the emergence of Know Your Customer and anti-money laundering regulations, which helped legitimize cryptocurrency exchanges and platforms. The regulatory landscape began evolving from outright skepticism to cautious observation. Governments started taking notice of growing transaction volumes and began implementing initial frameworks to bring order to what many called the Wild West of finance. During this transition period, we witnessed the first tentative steps by major corporations toward cryptocurrency adoption. PayPal began accepting Bitcoin payments through partnerships with processors like Coinbase, BitPay, and GoCoin in 2014. This marked an early milestone in mainstream payment integration, though PayPal was careful to clarify this didn't constitute full integration into their digital wallet system. Then came the institutional breakthrough that changed everything. The year 2020 marked a pivotal turning point when major corporations began adding Bitcoin to their balance sheets as treasury assets. MicroStrategy pioneered this strategy, with companies like Tesla and Square following suit. Tesla's $1.5 billion Bitcoin purchase in January 2021 represented approximately 10% of the company's cash reserves and served as major validation of Bitcoin as a legitimate corporate asset. This corporate adoption trend gained incredible momentum. As of 2025, more than 85 public companies collectively hold over 804,000 Bitcoin. The corporate Bitcoin movement demonstrated that businesses were beginning to view digital assets as legitimate stores of value and strategic investments. Major payment processors evolved from cautious observers to active participants. PayPal launched comprehensive cryptocurrency services, allowing users to buy, sell, hold, and use crypto for payments at millions of merchants worldwide. The platform now supports Bitcoin, Ethereum, Litecoin, Bitcoin Cash, and PayPal's own stablecoin. Visa announced in 2021 that it would allow transactions on its network to be settled using USD Coin on the Ethereum blockchain. This eliminated the need for crypto-native fintech firms to convert to fiat currencies, saving time and money and marking a major milestone in cryptocurrency payment infrastructure. Traditional Wall Street institutions underwent a dramatic transformation in their approach to cryptocurrencies. Goldman Sachs, which initially dismissed Bitcoin, reopened its cryptocurrency trading desk in 2021 and now holds approximately $710 million in Bitcoin ETFs as of September 2024. The bank's CEO David Solomon expressed renewed interest in Bitcoin and Ethereum, contingent on regulatory clarity. JP Morgan launched its own stablecoin called JPM Coin and established a dedicated blockchain subsidiary called Onyx in 2020, signaling the bank's commitment to digital asset infrastructure. The bank's approach evolved from research and development to commercial applications, with JPM Coin being used in actual commercial transactions. The regulatory turning point came in 2024. The approval of spot Bitcoin ETFs by the U.S. Securities and Exchange Commission on January 10, 2024, represented a watershed moment for institutional cryptocurrency adoption. This landmark decision provided institutional investors with a regulated and accessible gateway into the Bitcoin market. The ETF approval had immediate and significant impact. Bitcoin prices soared to multiple record highs throughout 2024 as investors poured billions into the funds. BlackRock's iShares Bitcoin Trust alone saw net inflows exceeding $37 billion, with total assets surpassing $52 billion. These Bitcoin ETFs collectively became the most popular ETF launch of all time. Current institutional adoption statistics demonstrate this dramatic shift in cryptocurrency perception. As of early 2025, institutional investors hold approximately 15% of the Bitcoin supply, with nearly half of hedge funds beginning to allocate digital assets to their portfolios. A Coinbase survey of 250 institutional investors revealed that one-third had increased their crypto allocations in the past 12 months. Looking forward, 64% of investors currently invested in crypto indicated their firm's allocations are likely to increase over the next 3 years, with none expecting allocations to decline. Among institutions not currently invested, 45% said they are likely to invest in cryptocurrencies within the next 3 years. The numbers speak for themselves. The global cryptocurrency market capitalization has reached $2.78 trillion as of 2025, reflecting substantial growth in investor confidence and mainstream acceptance. This remarkable growth highlights the increasing appeal of digital assets as viable investment options for both retail and institutional investors. Recent regulatory developments have provided greater clarity for institutional investors. The proposed Clarity Act would establish a dual-track regulatory system where crypto platforms can register with either the CFTC or SEC depending on asset types, providing much-needed regulatory certainty while offering strategic flexibility with appropriate oversight. Central banks worldwide are embracing digital currencies, with over 120 jurisdictions evaluating national digital currencies as of 2023. 9 countries in the Eastern Caribbean Currency Union have already launched central bank digital currencies, while 38 countries have pilot programs underway. Modern corporate cryptocurrency strategies have evolved far beyond simple treasury holdings. Companies are now exploring treasury diversification using Bitcoin as a hedge against inflation and currency devaluation. They're integrating cryptocurrency payments for goods and services, developing proprietary blockchain solutions for business operations, and forming strategic partnerships with cryptocurrency platforms and service providers. The shift in Wall Street's perspective represents one of the most dramatic reversals in modern financial history. Financial analyst Anthony Pompliano noted that Wall Street institutions have flipped around at the table, recognizing that cryptocurrencies represent new opportunities rather than threats. Financial institutions now view crypto as a means to drive revenue, attract new customers, and recruit talent. This transformation is evidenced by major banks and asset managers that were previously bearish on cryptocurrencies changing their stance as the market reached over $2.5 trillion in value. The SEC's approval of Bitcoin ETFs, which resulted in over $1 billion flowing into Bitcoin, further validated this institutional shift. The evolution of cryptocurrency from a suspicious digital experiment to a mainstream corporate asset class reflects fundamental changes in financial market perceptions, regulatory frameworks, and institutional risk assessment. The journey from Bitcoin's first pizza purchase to trillion-dollar market capitalizations demonstrates how technological innovation can overcome initial skepticism through demonstrated utility, regulatory clarity, and institutional validation. Today's cryptocurrency landscape bears little resemblance to the Wild West environment of the early 2010s. The combination of regulatory frameworks, institutional infrastructure, and corporate adoption has created a mature ecosystem that continues to attract increasing levels of investment and integration. As regulatory clarity improves and infrastructure develops further, the trend toward mainstream cryptocurrency adoption by multinational corporations appears likely to accelerate, marking a permanent transformation in how businesses view and utilize digital assets. The story of cryptocurrency's evolution serves as a compelling case study in how disruptive technologies can transition from the margins to the mainstream through persistence, innovation, and gradual institutional acceptance. This transformation continues to unfold, with implications that extend far beyond the financial sector into the broader global economy. This has been Shadowline News, bringing you the complete picture of cryptocurrency's remarkable journey from digital curiosity to corporate cornerstone. Stay informed, stay ahead.